Hello, welcome everybody. Today we are going to be talking a little bit about required distributions. Welcome to our YouTube channel for Capital Financial Planners, home of Retirement Fed, our federal employee retirement training program. Specifically, we're going to be talking about required distributions and how they affect federal employees, why they're detrimental, and why it specifically hurts federal employees in terms of tax brackets and tax planning. So, when we talk about RMDs, required distributions are specific to traditional retirement plans like your TSP, outside IRAs, 401ks. They all have a distribution that must commence at a specific age. For the most part, people right now are within that 73 age category. But if you were born 1960 or later, you're going to have to take out distributions by the age of 75. Now, a lot of people ask, well, how are these calculated? They're actually calculated by using an IRS divisor table. Essentially, the calculation breaks down to about 5% a year, roughly. And that percentage grows every single year as you age. One real key takeaway from this slide is that required distributions are not required by Roth IRAs or Roth retirement plans. So that means your Roth TSP, that means a Roth IRA. You are not going to have a distribution that is required from that withdrawal, right? One other aspect to this is that this distribution is treated as ordinary income. So when we talk about what else is treated as ordinary income for retirees, we're talking about pension, we're talking about Social Security, we're talking about any dividend or investment income, as well as rental income. These are all incomes that come in for federal employees, not all of them, right? But when you add on this RMD to that stack, generally it puts a federal employee in a higher tax bracket. So that's one of the reasons that we're making this video, just to make you aware of that. Now, your first year, you are allowed to push your distribution into the following year, but you need to take it by April 1st of the following year. And then you have a second one you would have to do by the end of that year. So you would essentially have to take two in the second year if you end up pushing your first distribution into that second year. You'd have two, okay? And then you would have none in that year, let's say where you turn 73. You elect not to do it. You're pushing your distribution for that year into the second year by April 1st, and then you've got to do the second one by December 31st. I hope that's not too confusing there. So what could be done if you found yourself in an issue where you're facing higher taxes? Really, there's only a couple things you can do. One is a distribution that is charitable. You can send some of your RMD to a charity. That would reduce the taxable RMD, which would be treated as ordinary income. But you can't do this until the age of 70 and a half. That's number one. And number two is you're basically having to distribute that out to charity. Now, this is a good method if you find yourself nudging up into a higher tax bracket. You want to reduce off of that bracket. You can donate some of your RMD to charity, but that's essentially the only thing you can do to reduce your RMD at that time. So if we look at an example, let's say the example is this couple. They're going to be retiring, and they're retiring at the age of 62. Well, let's take a look at their income. They've got $27,000 coming in from Social Security. Now, keep in mind, not all Social Security is taxable, right? Let's say their gross Social Security was $32,000. That means that their taxable Social Security, which is about 85% of the payment, will be taxable. That shows you right here $27,000, right? Roughly, right? Same would be for the second spouse, right? So it doesn't necessarily mean that's what they're actually receiving. It just means that's what they're being taxed on. Same for pension, just so you know. Not all of your pension is taxable, right? The contributions that you made into your pension system, most likely, let's say the first system, is going to be your own dollars coming out, that is not going to be taxable. So in this example, you could have something like maybe your gross pension is 44, the taxable pension is 41,200. You add all that together, that's your adjusted gross income. So once you have your adjusted gross income, that's when you are subtracting from that number your standard deduction or your itemized deductions, right? ID, whichever is higher, right? So in this case, we're taking the standard deduction, it is the largest. We're subtracting that off of the adjusted gross income, and we arrive at the taxable income, AKA ordinary income. So essentially, this is what determines your tax rate. So we have $66,000. We can easily see this puts this couple in the 12% tax bracket. Now, that will be their retirement tax bracket unless they earn more money. If they earn $17,000 or more income here, they'll be placed into the higher tax bracket. So, what would happen in retirement if, let's say, they have a sizable TSP? Well, $500,000, it's pre-tax. Let's say that money grows. That grows by 3%. By the age of 73 years old, they're going to have $650,000 in their plan. That's going to kick off an RMD close to 5%, little under, okay? And that $28,000 here is going to lift them into a higher tax bracket. That's exactly how a lot of federal employees end up paying higher tax, is simply lifting themselves in a higher tax bracket with that RMD. And now all of the income taxes that they'll occur on dividends, interest, capital gains, rental income, whatever it is from other investments in the future, will have a higher tax rate. So what can you do about that? Well, you can determine if your current tax rate or your tax rate immediately preceding retirement or after retirement, I should say, is going to be lower. So let's say in this example, they have $66,000 of income, $500,000 TSP. They have a $17,000 threshold until they break into the higher tax bracket. They know they're going into the 22% bracket later. It's a no-brainer for them to distribute money out of their retirement plan, right, prior to the RMD age. Why? They get the advantage of a lower tax rate right now. They get a lower tax rate than in retirement. And number two, it's going to reduce the RMD. Think about it. If you're transferring money out over a series of years, yes, you're getting taxed at it, but you're getting the advantage of moving it to Roth, which is an after-tax account that grows tax-free, right? Tax-free for the rest of your life, your spouse's life, your kid's life. And now you've lowered the amount in your IRA that's traditional or your TSP that's traditional, your RMD is less. And the goal here is to reduce the RMD, not to nothing. I mean, that's a good goal. If you had everything in a Roth, I'm pretty sure you would be happy, your spouse will be happy when they inherit that, and so would your kids. But if you did at least the bare minimum here, you would move enough to reduce the RMD down to a sizable amount that's going to fit within that tax bracket. So that's essentially what we're doing here. We're reducing the RMD to fit in that tax bracket, and we're ending up with a tax-free Roth. So that's the name of the game. We end up with a Roth that has no distribution or required from it at 73. That money can all be kept growing tax-free, and so forth. So the question is, well, Neil, do you expect me to be in a higher tax rate in retirement? That's contrary to what I've heard in the past. Well, take a look, right? Right now, we're sitting in the 2024 tax brackets, right? These are set to expire in 2026, right? And prior to 2018, look at the tax brackets, right? So the tax brackets and rates were not only higher, right, than current ones, for this is the fourth bracket, the third bracket is higher as well, but so were the levels of income. So the fourth bracket prior to 2018 encompassed $70,000 of income. The fourth bracket right now encompasses $180,000. So that just gives you an idea of the differences between those brackets. And we believe with the federal pension you're going to receive, the Social Security you're going to receive, plus this RMD, a lot of times it shakes out being in a higher tax bracket. Additionally, it affects things like Medicare premiums. Medicare premiums are based on your adjusted gross income before the deduction. So if you're going to be taking Medicare Part B along with your federal health insurance, you will likely experience a higher premium in your mid 70s when that distribution begins. Okay. So this tax implication analysis that we offer, that we do for clients, looks similar like this. We paint a picture from now until the end of your life. We look at what the tax rate implications are based on the income being computed. So for instance, this is an example of someone in the 22% bracket now. They drift up, looks like into the 25 when tax rates expire. They come down into a more favorable tax rate for a temporary point of time. And then once their required distribution starts, they kick up into a larger tax bracket. Then what this is also showing is an even higher tax bracket down the road. Take a guess why. The reason is if you were to pass away or your spouse were to pass away, then the tax bracket would only be on a single bracket. That's what this is taking into account, that one spouse passes away. Now that person's on a single bracket paying a lot higher. And if you have a big age gap, this would show and pop up probably around here or here to that bracket of that 33. So you don't want to wait to the end to do these things. You want to make sure that you're doing them and you're looking at what you're supposed to be doing the analysis, doing the homework prior to getting into your 70s. If you like this video, please like our video. If you're not subscribed to the channel, subscribe to it. We're going to be doing more videos like this as they come your way. And of course, if you don't know how to do that, you can just hit that button on the subscribe down low and then hit the like button right next to that. Lastly, if you are looking at all this data and you're saying, hey, I need a little more guidance, this is what we're here for. We give you the ability to schedule a one-on-one meeting using our QR code. We can address all these issues up top, or you can go directly to our website, redfed.com/register. So hopefully you thought today's video was informative. It's one of the many videos that we'll be producing on the channel. Stay tuned. We'll have stuff on estate planning, other tax planning stuff, federal benefits, TSP, all of those things. So thanks for tuning in. We'll see you next time.